So picture this. You're 32, maybe 34, sitting at your kitchen table on a Sunday night with a laptop open to a mortgage calculator, and you've just typed in a number that makes your stomach drop a little. $485,000. That's what a decent three-bedroom goes for in a town that 5 years ago felt affordable. You move the slider around, 20% down. Okay, that's $97,000 you don't have sitting in a checking account. You try 10% down. Now you're looking at a monthly payment, taxes, insurance, and something called PMI that you have to Google. And the number that comes back is more than double what you're paying in rent right now. And you sit there thinking, this is what everyone told me to do. Buy young. Stop throwing money away on rent. Build equity. And yet the math on the screen in front of you looks less like a dream and more like a trapdoor. My name is Jake, and I spend an unreasonable amount of time pulling apart the financial decisions people are told are automatically smart, the ones nobody questions because they've been repeated so many times they stopped sounding like advice and started sounding like fact. And home ownership in 2026 might be the single biggest one, not because owning a home is bad, it's not, but because the specific math of buying right now, at today's prices, at today's rates, has quietly detached itself from the math that made home ownership a good idea for your parents or your grandparents. And almost nobody is walking people through that gap before they sign. So that's what we're doing today. We're going to run the actual numbers, not vibes, not what your uncle says at Thanksgiving, the actual numbers. And by the end, you're going to understand exactly when buying makes sense, when it doesn't, and why the answer in 2026 is a lot less obvious than the industry wants it to be. Let's start with the number everyone fixates on, the mortgage payment versus the rent payment, because that comparison alone is already misleading. Let's take someone, we'll call her Dana. Dana is looking at a $450,000 home. She puts 10% down, that's $45,000 out of savings, and finances the rest at a rate around 6.8%, which is roughly where things have been sitting. Her monthly principal and interest comes out to about $2,650. Add property taxes, homeowner's insurance, and PMI since she's under 20% down, and she's looking at something closer to $3,400 a month. Meanwhile, a comparable rental in her area runs about $2,200 a month. So on the surface, Dana is paying an extra $1,200 a month to own instead of rent. And the instinct, the thing everyone tells her, is that it's fine because that extra money is going toward equity. She's building something. It's not gone, it's just moved into an asset. Here's the part that gets skipped. In the early years of a mortgage, the overwhelming majority of that payment isn't building equity at all, it's interest. On Dana's loan, in year one, roughly $29,000 of her payments go to the bank as interest, and only about $3,000 actually reduces what she owes. That ratio doesn't flip in her favor until well over a decade in. So when people say the mortgage payment builds equity, what they're not saying is how slowly and how much of that early money simply evaporates into interest with nothing to show for it except the privilege of owing less next year than this year. Now here's where it gets genuinely interesting, because this is the part almost nobody actually calculates. What happens to the $1,200 a month difference and the $45,000 down payment if Dana doesn't buy the house at all? If she rents instead and takes that $45,000 plus the $1,200 monthly gap and invests it in a boring diversified index fund averaging something like 8% a year. Let's run it. Year one, her invested down payment alone has grown to about $48,600. Add 12 months of that $1,200 difference invested along the way, and she's sitting on roughly $63,000 in her portfolio, having spent 1 year renting. Not dramatic yet. But let's keep going, because this is where the story usually gets cut off, right at the point where it stops looking impressive. By year 5, Dana's invested down payment alone has grown to about $66,000, and the accumulated monthly contributions, invested consistently, have grown into something closer to $95,000. Combined, she's sitting on roughly $161,000 in liquid, flexible investments. Meanwhile, the version of Dana who bought the house has paid down her mortgage a little, and if home values in her area rose at a typical historical pace, maybe 3 to 4% a year, her home equity, price appreciation plus the small dent she's made in principal, sits at somewhere around $130,000. So renting Dana is actually ahead, on paper, by about $30,000, and critically, her money is liquid. It's not locked inside a structure she'd have to sell, with an agent, with closing costs, with a buyer who has to actually show up. By year 10, the gap narrows a bit as the mortgage math starts working harder for the homeowner. But renting Dana, assuming she stayed disciplined, is still roughly even or slightly ahead, depending on the exact appreciation rate in her market. And here's the thing nobody puts on a chart. Buying a house, Dana also had to pay for a new roof somewhere in there, or a water heater, or a foundation issue, because owning a home comes with a maintenance cost that's typically estimated at 1 to 2% of the home's value every single year. On a $450,000 home, that's $4,500 to $9,000 a year, every year, whether she wants to spend it or not. Meanwhile, renting, Dana just calls a landlord. Now, I want to be really clear about something, because this isn't a video telling you to never buy a house. That would be its own kind of dishonest. What this actually shows is that the break-even point, the moment where buying starts to beat renting and investing, isn't automatic and isn't quick. In a lot of markets, at today's rates, that break-even point lands somewhere between year 7 and year 12, and it depends heavily on 3 things that most buyers never actually calculate before they sign: the mortgage rate they lock in, how long they plan to stay in the home, and what they'd realistically do with the money if they didn't buy. Most people assume the third variable is 0. They assume if they don't buy a house, the money just kind of sits there, spent on nothing in particular. That assumption alone is what makes buying look better than it actually is on paper. This is the part that I think gets buried the most in 2026 specifically, and it's worth sitting with. For most of the last 50 years, buying a home was a genuinely different equation because rates were lower, home prices relative to income were lower, and the gap between renting and owning a comparable place was much smaller, sometimes nearly nothing. Your parents weren't smarter than you for buying young. They were often playing a different game with different rules. When mortgage rates sit around 3%, the math tilts hard toward buying almost immediately because so much less of the payment disappears into interest. When rates sit closer to 7%, that tilt reverses, and the rental and invest strategy has a much longer runway where it's actually the stronger financial move. The advice didn't change. The math underneath it did, and most people are still running their grandparents' spreadsheet in a completely different rate environment. There's also a psychological trap here that I think is even more expensive than the math itself. It's the idea that renting is throwing money away and buying is automatically building wealth. Renting isn't throwing money away. It's purchasing a specific, finite service, a place to live for 1 month at a known, predictable cost, with no responsibility for the roof, the furnace, or the property taxes ticking upward every year regardless of what your income is doing. And buying isn't automatically building wealth either. It's making a leveraged, illiquid, concentrated bet on a single asset in a single location with real ongoing costs that most first-time buyers dramatically underestimate. Neither of these is inherently good or bad. They're just different tools, and the industry built around selling homes has a very strong incentive to make one of them sound noble and the other sound wasteful. So how do you actually think about this for your own situation instead of just absorbing whatever your feed tells you? Here's the honest framework. If you're confident you'll stay in the same home for at least 7, ideally 10 or more years, the math starts tilting meaningfully toward buying because you have time to absorb the upfront costs, the slow start on equity, and any short-term dips in home values. If there's a real chance you'll move within 3 to 5 years for a job, a relationship, a lifestyle change, renting is very likely the stronger financial decision because the transaction costs of buying and selling a home, often 8 to 10% of the home's value combined, can quietly wipe out years of equity gains. And if you're not sure, if your honest answer is, I don't know how long I'll be here, that uncertainty itself is information, and it's leaning you toward renting, not because renting is inherently better, but because optionality has real financial value that most people never put a number on. I also want to name the emotional layer here, because it's real, and I don't think pretending it doesn't exist helps anyone. There is a genuine non-financial value to owning a home. Stability, the ability to paint the walls, not worrying about a lease renewal, a sense of permanence. Those things matter. And if you can comfortably afford to buy and the emotional value is worth more to you than the extra return you might get from renting and investing, that's a completely legitimate choice. This isn't a video telling you what to value. It's a video making sure the financial side of that decision is actually accurate before you make it. Instead of running on a piece of advice that made perfect sense in 1995 and just quietly stopped being true somewhere along the way. Here's what I want you to actually walk away with. Before you buy in this environment, run your own numbers, not a rule of thumb, not what a realtor tells you, but your actual numbers. Take the real, all-in monthly cost of the home you're looking at, mortgage, taxes, insurance, maintenance, and compare it honestly to what a comparable rental costs in the same area. Take the difference And be honest with yourself about whether you'd actually invest it consistently if you didn't buy, because the strategy only works if you follow through on it. And be honest about your time horizon, because that single variable, more than the interest rate, more than the price of the home, is usually what decides whether buying or renting wins for you specifically. The house isn't the goal. The financial position you're in 10 and 20 years from now is the goal. Sometimes a house gets you there faster. In 2026, for a lot of people, it doesn't. And the only way to know which camp you're in is to actually do the math instead of inheriting someone else's answer. If you found this useful, subscribe to the channel. Drop a comment with your own numbers. I read all of them, and I'll see you in the next one.